Hello ma'am, welcome on Ticker TV. The way Brent prices are surging, I wanted to know how is the inflation outlook for FY19?
So inflation clearly has a lot of risk at this point in time. For if we were to just do some kind of rough calculations, then for every $10 move, $10 per barrel move in crude oil prices, we tend to see about 40-45 basis of an impact on CPI inflation. And of course, we've already seen that sustain. Now, hopefully, we do see some kind of a tracing back of crude oil prices. But if the oil, Brent is going to continue to be on the upside, then that is going to seep into CPI inflation. And this is just the direct impact we're talking about. Then there's an indirect impact through transportation costs, food inflation getting higher. So, all of this just has a feedback effect, and that tends to have a multiplier impact on inflation. So clearly that remains a big risk, and not just crude actually. I think inflation has a risk from other factors also. One is of course the MSP hike. We are still awaiting some more clarity on that. But having said that, clearly, somewhere around 55 to 65 basis is a impact which could be seen because of MSP implementation as well on CPI. So all in all, there's a big risk which is there on our baseline, CPI inflation trajectory that we're looking at. At this point, we're looking at around a 4.5% level, closer to by March end. But like I said, MSP plus crude oil prices will be determining how exactly will that 4.5% pan out eventually. And of course, there's a third factor which we need to take into account is the state's 7th Pay Commission implementation, the HRA component. So that also will have a feedback impact. So we'll have to see that. We may always talk about whether it's a statistical impact or not, but having said that, it does have an impact on the headline inflation that we'll be talking about. So all these three factors will definitely, put in a significant upside risk to our 4.5% that we're talking about.
On inflation?
On inflation, yeah.
Ma'am, not only the hawkish RBI minutes, but also the outright interest rate swap, OIS swap, has been hinting at a possible rate hike.
Absolutely.
So how many rate hikes, will RBI shift its policy stance, and will there be rate hikes now going ahead? And if there will be, how many do you expect?
Well, see, I think RBI, the way it is going, the RBI minutes at least, what they're suggesting, we already have Dr. Patra and Dr. Acharya having suggested a shift in the stance. So in June, probably 2 is definitely there. I think Dr. Ghate also seems to be suggesting somewhere a shift gradually. So we are kind of close to a balance, and there I think the governor's veto power may actually have to be exercised very soon. So the stance change looks much more likely, and it will now be followed with a rate hike. So earlier, the way we were looking at it, there's a possibility that we may see a 1 or 2 rate hikes without a stance change. And that would be the end of the cycle. We'll be probably in an extended pause mode.
Yeah.
Now, probably, with the kind of risk that we're talking about, probably a stance change is a must now. It becomes mandatory. We'll see that happen, and along with that, we may see a rate hike. It may be followed by a rate hike, or it may not necessarily be accompanied in the same policy, but it will definitely be followed by a rate hike. So, yes, the OIS market is already pricing that in. About 25 to 50 basis of a rate hike is kind of getting baked in. So, yes, like I said, between June to August, it's a little bit of divided, view, because June we may see a 4-2 still. By August, we would have probably had a better picture. We'll have to see monsoons.
Yeah.
So I think monsoon is a very important factor here. There is a possibility that food inflation surprises so much positively, in the sense that, we have we have a very good monsoon, and food inflation is so low that even if core inflation is sticky, it's still kind of balancing off the headline inflation, and hence offsetting some of the upside risks that we're talking about. If that happens, then the possibility of a rate hike gets postponed, even though the stance has changed to a withdrawal of accommodation.
Okay.
So I think it's a little early to talk about a rate hike immediately, but yes, the probability has definitely increased, I would say.
And I'm coming to the last question. Your outlook on the spot market, the rupee.
The dollar rupee.
Yeah, dollar rupee, yeah.
See again, we were of the opinion that sooner or later the depreciation bias in the currency is going to feed in. Last year, in general, structurally, globally, if we see, dollar had depreciated almost 10% or so. It provided a support to all emerging market currencies. So rupee also benefited significantly. Last year also, significant amount of global flows were there. So rupee benefited because of that as well. Crude was also okay. Commodities were kind of moving up on an uptrend, but it was getting offset by all other factors. So somewhere it was getting, it was getting balanced. I think what's happened now in the last 6-7 months is that the macro fundamentals have been worsening. So inflation is obviously moving on an uptrend. Crude is a major factor, so oil imports have started moving. In fact, if we look at the net oil imports, netting off the exports that we see, 2014 up to 2012 to 14, that 2.5 year period, the net imports for the annual net imports had overshot $100 billion.
Okay.
We are suspecting that if crude remains around $75 billion, then we could again see net imports back to 100 plus. It had gone to as low as $56 billion. Into FY17, it had gone to $56 billion. That is expected to double almost in this year. So clearly there's a big risk on the external sector. So external sector is a problem. Inflationary risks are huge. Fiscal slippage concerns are there. Growth is kind of doing well. So it's doing well to the extent that yes, at least high frequency data is suggesting that the worst is behind us. Maybe we are kind of doing so. There are pockets which may be not doing well, but in general, if you look at the corporate earnings data and the other high frequency monthly data that we get, it's kind of suggesting that we are kind of the worst is behind us. So all in all, if you look at this, the deteriorating macro fundamentals and the fact that globally also situation doesn't look very favorable. Yeah. Because of course we know that developed market central banks are beginning to normalize their policy stance. Depending on the inflation scenario that works out there, by end of this year we could be seeing a significant global liquidity squeeze that could further weigh on the sentiment. So I think all in all, the situation doesn't look very favorable. So we were, any case, expecting a depreciation in the currency. I think it's just happened a little sooner than what we thought. So we do maintain that we are going to be gradually moving towards 67.5. That's what we're looking at.
By when, ma'am?
67.5 we are looking at around December.
December, okay.
Yes.
And FY19 target?
FY19 end?
Yeah, end.
Yeah, so like towards the end we could be somewhere closer to 67 quarter or so.
Okay.
Yeah, so the broad range, if you ask, is 65 to 67.50 at this point in time. But not to miss out the political uncertainty risk for India specifically. We have a heavy calendar in terms of state elections, and then it culminates into the general elections in May 2019. So all of that, how it progresses, will also play a very important role, especially for the FIIs. At this point we're already seeing FII outflows even before the political risk has really materialized. So if by any chance any unfavorable outcome from the political scenario pans out, then of course we may see overshooting of these levels. But assuming that things do not get unstable on that account, then we're looking at a 65 to a 67.50 range.
Okay. Thank you, ma'am. It was a pleasure having you on Ticker TV.